Good evening, ladies and gentlemen. What's going on? How we doing this evening? Anthony, you don't like the transition, huh? What's going on, guys? Sack Trades, what's good, bro? What's going on? How are we all this evening, guys? What's happening? Let me get the music down to a level. Is the music moderate? How is it? Are we all good? I'm very well this evening, guys. I'm very well. Bit of a mad day as well, to be honest with you. We had a good little session today. Really good session. ZDC, I'm good, man. Members, what's going on? YouTube members, how you doing? All new people passing through to the stream. Welcome to the Traders Reality channel. My name is Tino. Let's have a conversation. So, before we go forward, who have we got in this room? I need to know who's in here. Nah, it's all good, David. It's all good. I haven't been in a bit. Feels good to be back. J. Ross. Joe Dross. J. Ross. Man, I can't say your names, man. Monty, how you doing, bruv? I'm good. I'm good. Yeah, tonight is... Can you please shed some light on what happened to dollar yen beginning of the Asian session? What has actually happened to dollar yen? Nothing. She's doing good. She's doing all good. When the Asian session starts, there's always a spread widening. Always across all forex pairs. They always widen the spread. So it's just give it a few moments. This is the dead gap time. So let them find their feet and everything will be all good. All right then. So Thopia in the house. Yeah, what's good, man? What's good? All right then. Let's have a conversation, guys. Let's flip the chart over and let's discuss what is going on today. So it has been quite an eventful day. All right. Now, what I don't like about today's price action is it has happened towards the end of the week. All right. Let me just sort something out so that it's clear for you guys to see. But the one thing that I need to really zone in on today, okay, is the fact that Bitcoin, well, we need to go back in time, all right, and we need to understand something, all right, and we need to know if what has happened previously is going to reflect on what are the chances of it happening again, okay? So we need to discuss the 30,000 zone, all right? Now, everybody understands, and for anybody new, in tonight's stream, we're going to be talking about why we may believe that this is a trap. Okay? Now, are the market makers trying to make us believe that so that we do the opposite and then they do the opposite? What are they trying to get us to do? All right? Because there are a lot of people today that have been trying to work out as to whether they're going to go short. Are they going to go, go long? Very few people today probably sat on the sidelines. Did anybody take trades today? Has anybody been trying to catch a certain move from this consolidation period that happened today? There you go. Okay. I'm stuck in... Who's stuck in shorts? Who's stuck in shorts? Type 1 if you're stuck in a short. Hell no. I like that. Tried and fed the whale. Okay. Yeah, but it's still... Yeah, but it didn't feel... Okay, I'm shorting... Oh, you're... Okay, fair enough, bro. Short from the high. Short... Okay. Okay. Traded the retrace on dollar yen. Nice. Okay, then. Cool. Cool. Ravis, 5 a.m. in Bali. You're ready. Good man. Okay then, cool. So I just want to try and work out, I'm asking that question because I want to try and establish what I'm going to be discussing now. Okay? In no way, shape or form is what I'm about to say financial advice. I will never tell you when to enter or when to exit. What I will tell you is how to understand the concepts of how this business model operates. Okay? This is a dynamic market. The business model has been designed and is created for the market maker. Retail traders are not, by the nature of this game itself, it's not designed for you to make money. All right? However, the market makers apply themselves in repeatable patterns. They have to. Why? Because the only way that they can get those patterns to repeat themselves is if they engage in creating fear and allowing greed to come in. They induce people to be greedy. They create fear for people to react to it. All right? Now, we are in an uncertain market. It will always be uncertain. Stocks, uncertain. Commodities, uncertain. Anything that you are involved in that is based on speculation is an uncertain outcome, and you have to be okay with that. If you're not okay with that, come away from trading, because you're going to burn a lot of money trying to set expectations or having expectations and then waiting for them to play out because you brought a system or you went on a course or you paid someone for signals. You get the idea. The reason why these services are available is because people are always trying to find a quick fix. There are no shortcuts in trading, my friends. Okay? The only shortcut that there is in trading is a shortcut way for you to lose your money. All right? That's the quickest way. This is the hardest, easiest way to make money. But if you understand how the game works, you've got an edge. And ultimately, we just need to find a system that gives us that edge. And then if we execute it repeatedly over a sample size, we've done it. Okay? So, this area is really important. Okay? Now, the reason why I'm talking about the 19th and the 20th is because we have seen how the market makers have repeated or are in the process of effectively forming this exact same pattern up here. Okay? Check this out. Here's the 30,000 mark. Now, we understand that when price drops, okay, so if you're new and you've come to the stream, okay, there's a concept that discusses that the way the market maker buys and sells positions. Okay? When people come to this marketplace, they come with money and they input orders, and that money is matched to other orders. Those other orders are by the market maker. He makes the market. He makes and he takes. That's what the market maker does. All right? So when you open a long, the market maker sells it to you, because you can only buy if someone's prepared to sell, and you can only sell if someone is prepared to buy. You can't have one without the other. Why? Because if you're going to buy something, when you want to sell it at a profit, the contract that has been sold to you has the liquidity so you can close your long in a position. Likewise, when you close your long at a loss, the liquidity that is matched against it, okay, it's going to take your loss and take it over as a profit to the contract that's been opened against you. All right? Just that basic understanding of knowing that when you buy, someone has to sell, and when you sell, someone has to buy, it's going to make you see things differently. For example, market makers bring price down to the lows. The only way that they can get people to get committed to the downside is that if they make them believe that price is dropping. Now, thousands and thousands of traders are watching many indicators and many moving averages, and they are watching these candlesticks. And when they start seeing certain patterns of behavior in candlesticks, they start making decisions. So the market maker endorses those decisions and feeds into it and creates this move to the downside. The market maker builds his longs as price drops, and that's where you see these vector candles, vector 1, 2 and 3. All right, when he brings price down below the 30,000 mark, he does this because he wants to get his longs filled below the 30,000 mark, so that when he comes out of that zone, right, he gets the best possible price and he's got the most amount of liquidity trapped in this zone. Because you can imagine all the guys that were going short in this zone right here, when price stabilized down here, okay, they were probably thinking, all right, you know, we're going to wait for a little bit of a retrace and we're probably going to add to our position. New York steps in, spikes the high. People are thinking, okay, cool. We're going to wait for another move to the downside. I'm going to open some more shorts. Bang, they bring price back down again. And then they come up, spike the lows, and then they shift out of the zone. Whilst the retail trader's trying to work out whether or not he should add more positions, the market maker is just gathering more and more liquidity so that he can get his longs realized at a higher point in the chart, okay? And the way he opens that liquidity and exposes it is by taking out the liquidation points and the stops for the guys who went short. The moment those liquidation points and shorts and stops get triggered, he's able to open his longs at a profit. All right, so his longs have been opened here and he gets them filled and profit taken as price rises up. Now, they've done that here at the 30,000 zone. Okay. Let's jump up to where we are right now. Let's pull off the whole number. What whole numbers are of interest for us right now? So we've got the 32,000 zone right here. Let me get that just right there. 32,000 mark. Okay. That is where everything is at right now. So are we seeing effectively the reverse of this? If market makers build their longs below key notable areas, okay, and get their longs filled below so they can break out from the low to the upside at the best possible fill, are they actually building shorts above the 32k zone and keeping price up in this range so that they can get the best possible price for their shorts, trap the liquidity to the upside, make the retail trader believe that it's going to go higher, and then break down? And then break through with the best possible fill. Look at where the notable volume candle comes in. Look at both notable volume candles. Where are they coming from? Spike up, come back down below the 32 zone. Come away, spike up, away from the 32 zone. Another pump to the upside. Failure, price brings it back down. Funny how this big green vector candle appears, and a lot of retail traders got committed to going long with Bitcoin. These are traps, guys. The market maker can only move price if he induces traders to believe something is happening. All right? Do we understand that? Okay, Willjoy, listen. Why is that important? Bitcoin. Willjoy's just said this, right? He said, Bitcoin is also about to break out on a major trend line. They could spike through it and then reverse down. Do you know how many traders are probably watching that trend line? They've probably gone and downloaded those books. They've probably watched a little bit of TikTok. They've probably spoken to some guy with a course that has said, take a trend line, draw it from here, for example. And if it breaks that point, if it hits this zone 3 times, so watch this. Take it the absolute high, for example, all right? Say, if it hits this line 3 times, okay? On the 3rd hit, get ready to open your positions. Because they've tested it once, twice, and then 3 times. Let's hypothetically assume this is the 3rd time, okay? The market makers would have spiked that area, trigger the liquidity that has got long positions filled at this zone right here, for example, spike it, hit the liquidity, and then reverse price back down to initiate and trigger the liquidation points and the stops for the longs. All right. Now, thousands of traders are probably marking off trend lines and they're waiting for pennants or bull flags, bear flags, Toblerone looking shape patterns and butterflies and what else is there? All sorts of stuff. Now, let me tell you something, guys. 90% of the patterns that people study today were applied in the stock market over 100 years ago. The patterns do still arise in the chart. Don't get it twisted. They do arise in the chart, okay? But we're in different markets now, and they are operated differently. Back in the day, you didn't have Forex, all right? Back in the day, you didn't have market makers. You had the actual guys that were stood in the pits, okay, that were effectively going to the boards, bucket shops, you name it, all right, and they were saying, I want X, and they would shout it out, get the tickets, fill them out, and then they honor them at the end of the day. Now it's different, all right? Now it's a whole different story, okay? There you go. 100 years ago, through phone calls, guys. Yeah? Through phone calls. That's how they used to move the market back in the day. Now, check this out. Bitcoin right now has done a couple of important things. It's hit the psychological high twice, and it's not gone further. The psychological high is a very important area in the chart. This is the highest point that they started the week off at. This is the highest point in the range for the rest of the week that the market makers had initially set their spread. Now we know one thing. It can break the psychological high and continue higher, or it can break the psychological low and break lower. Now for the new guys, the psychological high and low are probably the only 2 points of interest in the chart that you should care about. Okay? Avoid drawing your own support and resistance lines. They don't mean nothing. I promise you, they don't mean anything. All right? Let me cross-reference true support and resistance against your TikTok kind of guys. Okay? TikTok guys will say, that's a resistance point. That's a resistance point. That's a support. That's a medium support. In other words, their charts are as bad as mine. Okay? They are as bad as mine. Now, let me show you relevant support and resistance points. So we've got the psychological high, which sits at 32,419. Psychological low, 31,465. The daily open. Okay? The pivot point. The mid pivot points. The Asian session high, the Asian session low. New York high, New York low. UK Brinks, high and low. New York Brinks, high and low. Those are the true support and resistance points because they tell you a story. For example, the Asian session high and the Asian session low. This is the range that the Asian session effectively sets up for the rest of the session. In the sense, UK and New York. All right? Now, in the UK, you've got the Brinks. Now, the Brinks box is like, you know, the money truck. The Brinks box. Brinks truck, sorry. Coming with the money. In other words, the Brinks box itself is going to pretty much determine where the profitable trade may end up. For example, if you look on the 15-minute time frame, how could you have exploited the Brinks box today? Well, very simple. Coming out of the Asian session, Asia were initially setting up the shorts. Okay? They spiked the high, initiated the vector candle, and they brought price back down, came back up and stabilized. Coming out of the Asian session, they're getting ready to go into the UK Brinks. The UK session initiates a stop hunt rise, and then they drop price down to come down and test the daily open. UK sets the range. Then they hit 1, 2, and 3, shift out of the zone. New York session, exactly the same thing. Stop hunt rise, drop, New York reversal to the upside. So, Asia building shorts, UK building shorts, realizing a bit of a return, moving price down lower so that the US can effectively initiate their stop hunt rise, reversal, and then the New York reversal triggers another opportunity to build shorts at a higher point. Now, this is all happening around the psychological high. Okay? Look at what they're doing with the candlesticks, man. Spike, 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 up and down. They're hitting the highs and the lows. All right? Now, conventional wisdom will say that this is an area where price rejects and it's got no interest in going down further. Of course it does. It has an interest to go up and an interest to go down. Wicks on the chart are not rejection points. It's just the market makers taking orders. There's money there, guys. Someone went long there, or someone went short. Someone went long, someone went short. That's the name of the game. They are not rejection points. It's just that there was enough liquidity at the downside at here, here, and here for them to move price up. There was enough liquidation points for the guys who went short in this little move here. 1, 2, and 3 to keep the retail trader to stay committed to the short side. He shifts out of the zone and triggers the liquidation points on the way back up. All right. This game is all about traps. Your goal as a trader is to effectively work out what constitutes a trap or not. So ask yourself this question. When you see vector candles appearing at the highs, spike 1, spike 2, spike 3, spike 4, if they keep working a particular area to the highs and pulling straight back, it's because they've got liquidity trapped up there. There are guys that have gone long up here, and there are guys that have gone long up there. By bringing price back down into this zone and staying in this zone, they are keeping those retail traders up here committed, because those guys are just adding more margin to their accounts. People are depositing more money so that they can keep their trade alive. Now it's a game of survival. Now the market makers may do one of two things. They may even move price higher just a little bit more. Keep the retail trader committed. Keep him excited that he's going to realize a profit. Okay? Then the market maker will make a decision. Has he trapped enough liquidity to this area here? And if he has, he will reverse price. Now looking at the move, okay, it looks like that we have achieved near enough a rise level 1 retrace. Now the thing is, it didn't hit the 50 EMA, but you've got the confluence of the 50 EMA and the 200 EMA. If you go to last night's stream, I said exactly what has just happened. All right? Please go and watch last night's stream. I said that one of two things is going to happen. They're either going to spike down lower, retrace back to the 50 straight away, or they are going to stabilize price and it's going to go sideways so that they can bring up the 50 EMA to match and cross over the 200 EMA, and then volatility will step in and determine the direction. And they've done just that. All right? Now, what we need to consider also is this. These vector candles that are appearing at these points in the chart, are they just there to engineer shorts at the highest possible point? Because this is what we're waiting for, guys. All right? If this move here is going to be favorable and it's going to continue higher, well, then we look at what we can walk into. We are going to be walking into the 800 EMA if this move is solid. Okay? Why? Because we've got a previous pool of liquidity up here. Bitcoin, there's no cigars just yet until it actually comes up and breaks above the 800 EMA on the 1 hour time frame, which is actually the 4 hour time frame, 200 EMA. Look at that. There's the 200 EMA on the 4 hourly. The 50 EMA is pointing upwards. That's a good sign. The 13 EMA is crossing over the 50 on the 4 hourly. That's a good sign. Okay, drop down and determine the volatility across the board. You can see that the RSI volatility has actually compressed now, so it's any direction. Yeah. Now remember, as much as we can try and work out what the market maker is going to do next, at some point they may bring price back down to these vector points. Okay, they may not be finished yet. They could actually keep moving price up for a good week or so before they consider bringing price down. But because we are in a range and we're at a lot of confluences right here, we need to work out what's going to happen next. So let's make one assumption, and then I'm going to flip over to Ethereum. If they move higher from this point, okay, we may get a move up, and then we will get a retrace. Okay, that retrace will either come down and test the 50 EMA, because if the move comes up, the 50 EMA will cross over the 200 EMA. All right. People will then say it's a golden cross. What better time for the market makers to make traders believe that we are now going to the upside? He then continues to move price up. Then he will snap price back down and trap the traders who traded purely off the golden cross. Excuse me. Okay. Excuse me. All right. Let's assume that it's going to go higher. Now let's assume now it's going to go lower. if they trap enough traders on the belief that the golden cross has just merged, all right, and the 50 continues higher, right, many traders are going to be getting committed to this golden cross, all right? People are going to be talking about it, man. Go across any YouTube channel or any, technical analysis channel. I guarantee to you they'll start talking about the 1 hour golden cross, okay? Now imagine the market maker knows that there are thousands and thousands of eyes watching this. So he can exploit that. So what is the likely chance of price coming down lower? Well, they will move up higher before they move down lower, because they've got traders committed in this zone. Get a few more traders committed, then they'll bring price back down. There's your failure of the golden cross. Okay? Next point of interest would be in and around the 31,000 zone. So we've got to be aware of that. But because price is trading sideways and we are in the range of the psychological high and low, price is pretty stagnated. Okay? But based on what we understand about the whole numbers, there may be a chance that they are building shorts above this key 32,000 zone to bring it back down and test this area again of interest. And look what they did here. They built the longs below the 30,000 zone and they shifted out of the zone. They built the shorts above the 32,000 zone, shifted out of the zone. That's what we're trying to determine. Okay? Let's flip over to Ethereum. How is that for you guys? Are we good? Yo, Mike, what's good, man? Isn't tomorrow likely to be a false move anyway? It's not that tomorrow's going to likely be a false move. I'll tell you now. In Forex, Friday tends to be a day. One of two things can happen in Forex. They are either going to make a run for profit or they're going to just build a position for the next week. The same has happened in crypto. Normally on a Friday, guys, nothing happens. Price just stays stagnated. It goes to the side. A lot of scalpers try and exploit that. All right. But nothing really happens. Now, let's look at it from the market maker's perspective. Friday, there's a lot of liquidity about. Okay. But there's not that many traders. Few trades are being opened here and there. It's a Friday. Everyone's probably packing up, finishing early. No one's interested. It's Friday, yeah, and all that shit. Okay? But the weekend. The weekend is different. Now, all the guys that have been at work all week that haven't had the access to trade during the week, it's Saturday. Now they've got time to trade. Now they can say, hey, miss, go and get the kids, take them to the park. I'm staying home today. I'm going to sit in my cave and I'm going to trade crypto. I've got all day and all day Sunday to trade crypto. So Mr. Average Joe Blogs, he's getting prepared for tomorrow so he can then get his stuff set up to trade the weekend. Well, guess what? Market maker will say, let's build our base. Let's start accumulating so that by the time the weekend comes, all the institutional traders at their trading desks will be closed. We can now move price and hit liquidation points and exploit these retail traders that think they can trade on a weekend. Now, granted, some people can exploit the weekend, and those people are the ones who are proficient in any strategy. Okay? But we're talking about the average Joe, where the idea of cryptocurrency is now starting to get adopted across the board. All right? So, market maker on a Saturday. Volatility is high, but liquidity is low. What a brilliant place for me to move price and exploit retail traders. On Saturdays, usually you see a little bit of movement and then price just stays in one direction. How mind-blowing is it going to be for the average Joe who's dedicated these 2 days over the weekend? He probably isn't sleeping because he's on a live position and he's trying to realize a profit, but price isn't going anywhere. Then out of nowhere, it spikes up and completely throws him off guard. He then goes to work on a Monday feeling sick. The missus comes to him and says, hey, how was your weekend? Did you trade? He was like, yeah. Did you make anything? Yeah, just dribs and drabs. More like he just paid all the fees to Binance. Yeah? And then for the rest of the week, he's working out how he can actually exploit it again. So then on his lunch break, he tries to come to the charts and he tries to open trades, and he hopes that by the time he looks at his phone again, he's in profit. Guess what? He's liquidated. Do you get what I'm saying? Yeah? This game is psychological, guys, because people are made to do things, all right? People see the charts and they think instantaneous wealth. Well, tell you what, I'd be involved in this game if I knew I could make a quick buck. You know? This is not the Wyckoff method. The Wyckoff method itself is based on a development of a cycle or a behavior of price. It doesn't factor in time. It only factors in distribution and accumulation zones, point B's, C's and D's. Okay? This strategy incorporates Steve Mowry market maker method and the PVSRA strategy by Trader at Home. I've taken both of those schools of thought, studied them both, okay, and brought them into what we understand and call today the hybrid system. All right? And what I found is you can't have one without the other, because either one compensates. The Steve Mowry market maker method is about understanding trading in time and patterns. PVSRA's understanding about the intention of the market maker with big vectors to the upside and vectors to the downside, and paying attention to every single candlestick that appears. All right? If you are new to the stream, guys, all right, head over to the Discord. There is a plethora of resources in there. All right? You can get access to it. If you want these indicators, they are free of charge. Go to the links in the description. You can download them. You can download MT4. Everything is there in the description for you. Okay? Let's have a conversation about Ethereum. Now, I've said it before. Ethereum is technically the best crypto coin to trade. Out of the big players, Ethereum is the best one. Okay? Bitcoin's pumping. Oh, man. Okay, fine. Ah, God. In my opinion, that's not a pump. Sorry. I don't think that's a pump. Break away from yesterday's high, that is a pump for me. Okay? But all they're doing is just trying to go back to the previous zones that they went to before. 1, 2. Is that going to end up as a wick? Is it going to end up as a wick? Shorty shrew, that's rough. If you pumped your girlfriend like that, she wouldn't be impressed. That's rough. Funny how it happens at the last 15 of the hour, of course. Here's something for you new guys. Okay? Always pay attention to the final 15 minutes of a 1 hour candle, and pay attention to the first 3 to 5 minutes as well. All right? The reason being is because that's when they start moving price. Okay? Joshua, does that mean that the psychology we should have is the higher price goes, it's a trap to longs so they can start building shorts, and we should short the pumps and long the shorts? By principle, yes. However, it's not that simple, okay? Because when they're raising price, by that token, when you see green vector candles, we understand them to be the market makers building shorts at the highest possible point. However, look, when you see red vector candles, they're building their longs at lower prices, yeah? When they're moving the green vector candle up, they are realizing shorts at higher prices. However, when they're building longs at lower prices, they are also closing shorts. That's why vector candles are aggressive candles, because they are double liquidity. It's double liquidity. They're doing two things. That's how they're able to move price. Yeah? Because this move to the downside may be taking out the guys who went long here and hitting their liquidation points. When they hit the liquidation points, they free up the liquidity to open up their longs. Okay? At the same time, by closing their shorts from previous moves before, they are tricking the retail trader to close his longs and go short. By the time they've got enough traders to commit to the downside, those traders are setting their liquidation points for their shorts and their stops. So then the market maker stabilizes price, creates the illusion to the retail trader that it's just a break and then it's going to continue down lower. Then he gets them committed to either adding more positions because they're feeling like they're great traders and they think that it's going to continue lower because it keeps on going lower and coming back up. All right. Then when he shifts out of this zone, the longs that he realized here, he uses the liquidation points for the shorts by the retail trader to open and realize a profit on the longs that he built here. At the same time, he's then using the same movement to open shorts at higher prices. It is a bit of a mind. You get what I'm saying? Okay? But once you understand that, that's what's going to help you understand when you see price rising, you know that the moon... What did we just say? What did we just say about this, man? A wick. 1, 2, and 3. How many people just looked at that? Now, my guy just said Bitcoin's pumping, okay? Now, imagine how many thousands of people are watching Bitcoin right now and they saw that happening. How many of them went in and opened a trade? Yeah? Psychological. Look at what's happened right now. Some poor soul went long right here and he's probably trying to add margin to his account right now. That is very unfortunate for my guy. You know? Very unfortunate. It is a bit of a sticky one. Could there be a W on both? This is just the first leg. Depending on what time frame you are considering, always understand that a W formation needs to appear below moving averages. Okay? So, we've got ourselves a little W formation here, which looks like a inverted head and shoulders, but it's quite a small pattern. All right? If we zoom out, right? Look at what we've got here. We got the big daddy here. Big W formation. Now remember, W formations do not have to be as static. They are variable. They are dynamic. Okay? The purpose of these streams is to get you to train your eyes to see as many variations of W's as you can, so that once you've understood how a W develops, you can then go back in the previous charts and draw out many variations of a W and look at how price moved away from it. Once you've trained your eyes to see a certain development within a W formation, when you come to the hard right of the chart, you're going to understand that when you see price dropping down like this, you're going to say to yourself, okay, it looks like the first leg of a W formation. Let's mark it off. You mark the first leg. Then you wait to see if price rises up from that point. Okay, if it rises up, stabilizes, and then drops back down and holds in this area, you've got yourself the second leg, and then you're waiting for the next move, which is a shift out of the zone to the upside. All right? It's all about training your eyes to try and find how the patterns develop, because as much as the patterns do appear again and again and again, we won't know when. We just need to work it out based on the vector candles. Where do they develop? Are they holding at the 50? Are they rejecting the 50 to trap the retail trader to believe that the move to the downside is going to continue? Get them to commit their liquidity. They drop price, but they stabilize in this zone and hold the zone, and then they shift out of the zone because they've trapped all the money here. Okay? Which time frame do you look for W's? It all depends on your strategy as a trader. Are you a scalper? Are you a swing trader? Are you a position trader? Or do you just, hold? Yeah, it all depends on what your goal is. But the foundation is the 1 hour time frame to establish the cycle, okay? And the 15-minute time frame is going to help you find the pattern, but you can also get patterns on the 1 hour time frame, and you can get patterns on the 4 hour time frame, and you can get patterns all over the place. So in other words, there is a pattern within a pattern within a pattern, okay? but the time frame that you trade it in is going to correspond to how long that pattern is going to be valid for. So if you find a W on the 1 minute time frame, granted it may work, but it won't last. A W on a 4 hour time frame is going to take a while to develop, but when it moves out of the zone, okay, it's going to move out of the zone. Same retail added margin to a trade when it only dropped $10. Vitali, it drops $10, yeah? But you've got to understand, there are people that are trading big size, yeah? Bitcoin drops $10. How do you not know that someone's made nearly $500,000 on that move? And they want to try and save that liquidity. They want to try and save that trade by adding margin to it. You know? Do not think that because it dropped $10, it ain't going to be a big move. To the retail trader, $10 is nothing. But to the guy who's playing with the bigger money, he's got to try and protect his account. All right? That's what the market maker thrives for. He wants to take out that guy's liquidity. Nothing to trade spot, no leverage, only trade upward. Don't have enough experience or cash to trade with leverage. There's a gap in price about 25k like a few days ago. We're only about 2-3k from that range a few days ago. That's true. Is there a W zoomed in though? A smaller one for this week? Yes, there is. Look, 50-minute time frame. Oh, what's it doing? What's Bitcoin doing? Oh wow! There you go, guys. There you go. Stop, hunt, rise, drop. Recovery of the vector candle right here. Look at what they're doing above the 32,000 zone. You're gonna, if this candle continues, this candle should break down below the 32 zone with a red vector candle. That should turn red because it's a very fast move. Look at the stop, hunt, rise. One more spike to the upside. Commit the trader to the upside. Get his positions filled. Hit his liquidation points now as price now pulls back. That is a very sharp move back, man. That is really, that's market maker behavior for you guys right there. Look at that. That candle is going to turn red by the time it turns to the 32 zone. All right, if it doesn't, I'll be very surprised because there is a ton of orders at the 32 mark. They've been trapping liquidity in and around this zone, so we've got to be careful. Be careful. Now I want that red line. Let's see what happens here. What you're witnessing now is if this breaks down, then you would have understood why. Because we've been talking about it all day. Especially with the patrons. Patrons, we've been talking about this all day because we've been focusing on what's been happening here. Look at this. Red vector, red, 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 red. Try and say red as many times as you can and you just start losing your tongue. But look at what they're doing. Building longs below the 30,000 zone. Building longs at the lowest possible point. Keeping price within a range. Okay? Pins to the low. 1, 2, and 3. Get ready to shift out of the zone. We've got enough traders committed to the downside. Let's shift out of the zone. They've done it. Okay? Look at what we're doing right now. Green. Green candle. Green. 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 Why is it they are trying to move price higher? We're seeing green candles. That means price should be going higher, but it's not going anywhere. Why? Because they're building shorts above the key 32,000 zone with intentions to move price down lower and get the best fill. Okay? Now all the liquidation points for all the retail traders who have been long are going to get ready to get taken. Because those guys, or the retail trader, he's irrational. He doesn't know when to take a profit. There are retail traders right now that are sitting with good profits. And they're just going to watch price dwindle their account because they're going to say, yeah, it's just going to retrace. I'll wait for the pullback, wait for the pullback. You know, if I'm watching off the 50-minute time frame, I'll wait for it to come down at least to the, you know, the daily open. And if it breaks that, we've got the 800. It's bound to bounce from that point anyway because you've got the 200 EMA crossing over the 800 EMA, which is effectively the 50 EMA crossing the 200 on the hourly. Yeah, I'm just going to hold my trade. That's the sort of mindset that these guys have. Okay? They have that sort of mentality. Yeah? That is a stopping volume candle right there, my friends. Stopping volume is when the market maker steps into the chart and prevents price. He induces people to believe that price is going to go one direction, but then he brings it back straight away, because if he allows the liquidity to be released up here, the retail trader is going to realize a profit, and the market maker is going to be obliged to fulfill that, because when it's rising, the retail trader is going to take profit, and the market maker is going to do what? When the retail trader sells his long, the market maker has to buy it back. And he's then buying it back at a loss, which is why price always ends up pulling back every time it makes a massive high. Okay, it always pulls back because they've trapped liquidity at one point, so they can then build their shorts at the highest possible point and reverse it back down by opening their shorts, realizing a return on them by hitting the liquidation points for the guys who went long in the move previous. Okay. Yes, this is true. Not all W patterns play out. Do not make the mistake of just simply coming to a chart and thinking, okay, that is a W, I'll take that. No, it's not a static pattern, it's dynamic, which is why the focus is confluence. You are adding caution to caution. You are trying to improve the odds. It's all probabilities, all right? You're going to go up to a girl in a nightclub or in a bar or wherever. You want to improve the chances of her actually paying attention to you when you go up to her and talk to her. So you're not going to go there looking like dog, are you? No. You're going to make sure that your breath is fine. You're going to make sure that your shoes are clean, or at least your clothing is in the right spot. You're going to probably pre-master your mind or your walk or your mannerisms, so that by the time you come up to this girl, she's going to be so amazed by you before you even talk, she's saying yes please. That, my friends, is confluence. The same thing applies in trading. If you're going to wait for a position or a pattern to play out, you want to add the confluences together. Where's the 50 EMA? Where's price? Where's the moving average of the 13 and the 5? What's the RSI saying? Are we at above a key number? 30,000, 32,000. Where's the vector candles? Are we in the New York session? Are we at the high? Are we at the low? Do you get it? Yeah? Don't worry. I will talk about Ethereum. But you want to understand why I talk about Bitcoin. Because that is the fashionable coin. Come on. Give me the red vector. Red vector candle. Please give me the red vector as you break through the 32 zone. First pool of liquidity that they've got an opportunity to capitalize on is right here. I need to see gold. What's gold doing? Gold has just started to trade. Dollar yen. Gapping up again. Getting ready to make a move. There is a fractional disparity with dollar yen, gold and Bitcoin. Because they trade against the US dollar, when Bitcoin against the US dollar drops, dollar tends to rise. When gold drops, dollar tends to rise. Because the idea of gold is this, it's a safe haven. And gold has been dropping quite a while. She's hit two projection points already. Projection 1 and 2. She's now on her way to try and take 3 and 4. It's Friday tomorrow. If you go back in the chart in gold, you will see gold one day went from, I think it was about $1,700 an ounce, and it went all the way down to like 1,100. That is a big move for gold, man. Big move. And I just watched it happen. It was the craziest ride ever. All I saw was just this red line going down. It was crazy. Gold is a crazy pair to trade. Its ADR is a nearly 200 pip move. Nearly 500-600 pips a week that you can get from gold. What a coin. Or pair, currency, whatever. Come on, Bitcoin. Give me that vector. Okay, then. Ethereum. Let me just talk about Ethereum for the guys who love the Ethereum game. Alright? For my blockchain fellow men and women, Ethereum, as I have said, technically is the better coin to trade. Why? Because she respects zones. Okay? Now, we noticed something. When Bitcoin today traded down to its daily open, Ethereum took her time. She didn't hit it straight away. Okay? So, is the 2,000 mark on Ethereum, which is what she's just done. She's actually triggered the 2,000 mark and pulled straight back. So there's a bag of orders that have been filled there, and now they're hitting the liquidation points for them. Okay? Are they going to break through it? Because we have got a lot of liquidity that we can take. Look. Oh, vector candle. There it is. It appeared on Ethereum. She's recovered the green vector right there. We've got this wick right here. Yeah. Psychological low right there. Is that psychological high right there? This is just screaming price to go down. It really is. But if they don't bring it down and they hold this zone, then boy, one more move up and then they will be freeing up the liquidity up here. That is probably the best place for them to get their shorts filled at the highest possible point and then drop. But it all depends on what they're going to do next. Okay? Ethereum is still doing the same thing. Look, the $2,000 mark. Look at what they're doing. Spike up, up, up. Spiking, spiking. Working the highs. If they keep hitting the highs, okay, and not going higher, they are building shorts above these zones. Alright? Because that's the dynamics of the way the business works. They can't do it any other way. Do you think market makers buys when the price is rising? No. He ain't gonna do that. That's a mugs game. He ain't gonna sell when price is dropping. Yeah? How many of you sell short when price is dropping? Say one. Come on. How many of you sell open shorts whilst price is dropping? Okay, 1, 2, 3, 4, 5, 6, 7, 8, 9. Okay. Harambe for president, fair enough. Okay. Okay. Now, let me explain something. You can open shorts whilst price is dropping. Only if you're catching momentum. Alright? But do not make the mistake. Try your hardest to not open shorts when you see price dropping. Okay? I'm talking like this. Look. Watch this. Okay? If you start opening your shorts as it starts to drop, fine. But don't wait for it to drop and then open your short thinking that it's going to continue to drop. There's a big difference between the two. Alright? What you want to do is, if you understand the concept and you understand the behavior of what's been going on and you've got a bit of market structure behind you and you've been following the currency, the pair or the currency coin, whatever, all right, and you've got a consensus that you believe it's going to go down lower, when you see these fake pushes to the upside, that is when you start building your shorts, because you are favoring lower prices. You are behaving with the market maker. You're doing what he's doing. Now, the key aspect to doing this sort of trading, okay, is to trade light. All right? This is exactly what I've done with my dollar yen trade. This is how I've built positions. Building positions. Started building positions whilst price was whacking up and down in this zone right here. Realizing returns. I built more positions today right here whilst price was dropping. Built more positions up there yesterday. Okay. On the vector candle, as the vector candle came to the lowest point right here, I waited for it to finish. Then I opened long on dollar yen right here. I opened about 10-15 positions at this point here because I anticipated price to come back up. The same principle is going to be on Bitcoin and Ethereum. You build your shorts as price is rising, and you use light amount of money so that you can withstand these spikes up. Because if you're catching a move to the downside, you are waiting for it to happen. As price rises, you're building the short so you're catching it at the highest possible point, okay? So that by the time you've caught the highest point in the chart for the short, by the time price starts to break down, you will be in some serious profit. And the shorts that you had built from down here, okay, they may still be in red, but price only needs to move from this point where your last short had been opened, and it only needs to move down to this point right here, and you're in really good profit. Okay? Just like the market maker. Of course, PC Shed. Well, there's no point in studying what they do and doing the opposite. Okay? Right now, the market maker has initiated a stop hunt rise drop. Now we're going to slowly see price come down towards the 32 zone. But we also have to accept uncertainty, my friends. All right? We have to accept uncertainty because they could just switch it up and go back up again. And you've got to be okay with that. You have to be okay with that. We are studying something. I'm talking about a business model that works for the market maker. You know, us guys in the stream, the Traders Reality family, understand how they operate. And we are going to ride the coattails. That's the saying. Yeah? We're riding their coattails. We're just trying to grab onto it and hold onto it for as long as we can and let go. And then wait for the wind to turn so we can grab onto it again. All right? If you are new to this channel and you've been here just, you know, a couple of days or weeks or months, all right? Don't try not and put too much pressure on yourself to understand this game, all right? I'm taking 15 years and trying to summarize it in 1 hour on a stream, okay? There's over 1,000 hours worth of streaming on my channel where we're talking about patterns and market makers, you know, people coming into the stream, asking questions and doing all sorts of things. And I'm trying to answer everybody's question, okay? This, for you guys, is to help you try and understand the game that has been designed to make you lose. If 95% of traders lose, all right, it's because 95% of them are doing the wrong thing. They come to this game with the wrong understanding, all right? Let me tell you a story. Who wants the story? How many people are new in this stream? I'd like to know. How many people are completely new to the stream? Or have I got my family in here tonight? Because I ain't going to chew your ears off and I'm going to finalize the stream after this story. How many of you are completely new to this stream? How many? What have we got? Okay then. Wonderful. I'm going to tell you a little story and then I'm going to finish it. Okay? Notice how all the members are saying no. All right then. Here we go. Firstly, thank you for passing through to the Traders Reality channel. My name is Tino, and let me tell you a story about jumpers, okay? Let me tell you a story about jumpers. Why are jumpers important? Because the idea of this story is to help you understand the concept of supply and demand, which is why 95% of traders lose. They're coming into the game with the wrong concept already. Of course they're going to lose. Now, a lot of people talk about the psychology of trading. Yep, you know, don't be emotional, don't be fearful, don't be greedy. This is basic stuff. People aren't focusing on why people become fearful and why people become greedy. And it's because people are applying basic concepts that were applied years ago, but they don't apply today. So, let's have a conversation. This big move to the upside, all right? In textbooks today, all right, supply and demand says that if you have a product, right, and more people want it, you would agree that there is a demand for it. So we're on the same page. Likewise, in order for people to have more of it, you need to be able to supply it. Okay? That's the concept. Supply and demand. So, when we come into a chart and we see price rising and rising and rising, the theory would say that there is a demand. The moon boy is stepping into the chart. The avid investor is stepping into the chart. Tom, Dick and Harry are sat at a coffee table and they've seen Bitcoin starting to make a move. They all pull out their phones and they say, yo man, go long on Bitcoin, it's rising. So as the great friends that they are, they're all going to do the things together. They're all going to open positions on Bitcoin and hope that they're going to turn into, crypto millionaires by the time they finish their £2.50 cost of coffee. All right? Price is rising and rising. There's a demand. It's going across the board. Buy Bitcoin, it's rising, it's rising, it's rising. All the while, these guys aren't paying attention to the idea of why it's rising and how is it able to rise. See, conventional wisdom will tell you that when price is rising, it means the buyers are in control. And I'm telling you now, my friends, that is a lie. Because if you heard at the start of the stream, in order for someone to buy, who is the opposite person? Who has to be on the other end of the stick? The market maker. He has to sell. He has to sell you the contract. So when price is rising, rule 1, when price is rising, the seller is in control because the buyer can only be a buyer if someone is there to sell. Because if we take the token of supply and demand in this zone, okay, the theory itself, it's flawed. You're saying to me, when there is such a massive demand to the upside, you're saying that this is a rejection, that the moon boy is satisfied with the amount of money that he's made and he's not interested in letting price going up. He's not going to continue to buy. Oh, please. Supply and demand only works in one place. Retail. There's a man. He starts his own clothing brand. He has 3 colors. Green, red, and yellow. He sells jumpers. He sells 5 green ones, he's selling 5 yellow ones, and he's selling 5 red ones. He opens his shop and he starts the trading. People come in, have a look at these jumpers. Great. Why have you only got 3 jumpers? And he goes, I just like selling jumpers. These are my 3 favorite colors. By the end of the trading day, he notices he's got 0 green jumpers, 2 red jumpers, and 3 yellow jumpers. When he does his stock check, he knows that there is a demand for green jumpers and he hasn't got the supply for it. So the concept of supply and demand is valid there. He needs to buy more green jumpers to effectively fulfill the demand for the guys who are coming in buying it. But if we bring that same concept to the chart, okay, if price is rising and rising, it means that there are no more contracts up here. Get the no way. You're saying to me that the market maker pauses? No, should I say the retail trader is deciding to stop making money at this point? No. The reason why price pulls back at the highs so aggressively is because the market maker has trapped the liquidity. He's got enough people committed by demand to come in and bring price higher, because the only way price can rise is if the market maker sells the purchaser. You can't walk into an empty shop and ask to buy everything if he's got nothing to sell. Same as you can't walk to someone and say, I'd like to sell you this. And you say, well, what is it? And you say nothing. Well, I've got nothing to buy then. You get it? So what I'm trying to say to you guys, why 95% of traders lose is because they are applying economical principles that do not apply in this game. The reason why price spikes up and pulls back is not because there's no interest up here. It's because the market maker has trapped enough liquidity at this point for him to open his short and move down. There are people that are setting orders as price is rising. So the market maker sends price up these areas, triggers the liquidity, then he turns the direction opposite so that he can hit the liquidation points and bring price back down again. That's market maker behavior 101, my friends. And on that token, I think I'm going to call it a night. I hope you've enjoyed tonight's stream, guys. I hope it's put things into perspective. We've really covered a lot of concepts this evening, and I hope it's actually got into your brain. Okay? But if you are new, feel free to subscribe if you like what you're watching. But my goal is to try and educate as many people as possible about this game, because in this world today, guys, it is done. All right? People are losing their jobs. People are losing businesses. Homes are unstable. It's crazy, man. But the markets are still moving. So this is me paying forward. I ain't getting sentimental with you guys. You probably heard me say this many times in the previous streams. But that's the truth. All right? It costs me nothing to show you how to do this. It costs me time. Don't get me wrong. You know? It is a hard graft. It's a hard grind. But, you know, I've got my team with me. Mike, Bitcoin Spartan, Infinex. Many other people that are helping behind the scenes as well. We've got my guy, Espresso Addict, who created the stream introduction. Give some love to my guy, Espresso Addict. Thank you so much for that, brother. There's plenty of more to come from him as well, man. All right then, guys. Listen. Thank you very much. Okay? I hope... You know what? You don't need to worry about the likes, guys, all right? As long as you're here, happy days. That's all I'm interested in. All right? You just make sure that you just click the little bell and hit that bait massive subscribe button. You know, it's obvious, it's in your face, and it costs you zero. That's the mad thing. It's free to do, but yet people don't do it. And I don't get that. We're always quick to say, how much is that? Or can I get it less? Or can I get it free? And then when we say to you, press this button if you like what you see, and it means that every time I go live, you're going to see me if you like what you see. But people don't do it. Ah, YouTube. I've only been on YouTube 6 months. My account itself has been, what, since July last year. I stepped into cryptocurrency. Let me give you a little bit of a story. Stepped into cryptocurrency in January the 21st while I was waiting for a cup of tea to brew. I was in my kitchen. I brought myself a new laptop. I was like, you know what, let me see this power of this laptop. Okay? So I went to YouTube and I went go live. And I thought, what am I going to talk about? I'll start talking about the charts. Before you know it, I had about 15 people in the stream. And I was like, wow. And I didn't really know what I was doing. I had no transitions. I didn't have no OBS. Well, I had to have OBS to do it. Okay? But there was nothing fancy. And then 15 people ended up being 150 people and then 200 people. And I absolutely lost my mind. I didn't know what to do. So I thought, okay, let me try it again the next night. And before you know it, I'm talking about breaking down price with this strategy. And we are here today. 6 millionaire traders created from the system. Many more other people making an absolute killing. People that have been out of work and got little money aside for trading, come to this channel, study the strategy, and now they're just trading consistently. So many walks of life have come into this stream, and I've met so many beautiful people, and their lives have just completely flipped. That's my paying forward, man. I hope I've served you guys purposely and well. Have a lovely evening. Mad love and respect to you all. Peace.